Good afternoon, ladies and gentlemen, and welcome to the SHEARWATER Group PLC investor presentation for the final results for the year ended 31st of March 2021. Throughout this presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time. Just click on the Q&A tab at the top right-hand corner, type your question and press send. The company may not be in a position to answer every question received during the meeting itself. However, the company will review all questions submitted today and publish responses where appropriate to do so. These will be available on your Investor Meet Company dashboard, and you'll be notified once they're ready for your review. I'd also like to remind you that this presentation is being recorded. Before we begin, we'd like to submit the following poll. I'd now like to hand you over to Phil Higgins, CEO, and Paul McFadden, CFO of SHEARWATER Group PLC. Good afternoon.
Good afternoon, and thank you very much, and welcome everybody to our final results presentation for year ending 31st of March. I'm just going to take you through a few. First of all, let's go through the disclaimer, and quickly moving on into a little bit more about SHEARWATER. Just reminding you as to who we are and what we do. So in a sentence, SHEARWATER is a group that provides technology solutions and professional advisory services. We focus around the cybersecurity and regulatory requirements of corporate clients. Simple as that. The vision of our group is we want to become a provider of choice, and we believe that our offerings will help our clients identify and manage their risk and maintain their compliance against a constant barrage of cybersecurity threats. We deliver our business through two different divisions. We have a software division consisting of Secure Envoy and GeoLang. Our software division, here we design and build leading-edge software which helps our clients secure and make their corporate environments more compliant. Collectively, this division delivers 14% of group revenues and 41% of operating profit. Our softwares are sold through a two-tier distribution model. We currently have in excess of 350 global resellers who represent our products internationally. The group is, our international footprint has been growing even during the pandemic. We've managed to add a few more locations where the resellers are now representing our software to their client base. On the other side of the business, we have our services side. Here it consists of Brookall, Xena and Pentest. Here we focus on delivering our group's managed services, our security, cyber and solutions, our professional advisory and consultancy, as well as our penetration testing. We also manage our third-party strategic partners. Here, collectively, the group contributes 86% of group revenues and 59% of operating profit. Our services are sold to the FTSE 350 and Fortune 500, also governments and some local SMEs. Whilst we do remain largely a UK-based company, we do service our customers across 46 countries globally at the moment. And we deliver all of that via circa about 90 employees operating from currently 5 offices. And you can see there in the little blue box some of the core services that we actually deliver to that client base. Moving on. Obviously, it's all about today. Yeah, I am so pleased to be able to report that fiscal 21 delivered ahead of expectations. We improved our margins with good cash control. It allowed our Ebitda to come in ahead of analyst expectations. We had improved margins. We saw a bit of a shift in terms of the type of transactions we were engaged with. We saw a reduction in the appliance-based computing with a shift more towards software and subscription-based computing. It did soften our top line in H1 last year, but more importantly, we did manage to pick some of that up during H2. But what it did do, it actually gave us back a better quality of revenue. Obviously, we're a resilient-based company ourselves, so it would be wrong for us not to be able to cope with the COVID situation. We did so. Our teams are fantastic. They managed to very quickly adapt to the new working environment, working from home. I'm glad to report that we didn't take advantage of the government furlough system. We kept all of our staff employed. In fact, we were actually recruiting during the period. But one thing we did do is take advantage of the government's VAT deferral, and Paul will come on to that later on. One of the key initiatives that we started 2 years ago was a cross-selling program inside the group, where previously we were leaving so much opportunity on the table. We want to take some of that off. So particularly inside our services side of the business, we looked at a mechanism to reward our staff to actually share client base, make introductions and so forth. In the first year of operation with that, we delivered circa 100,000, just shy of £100,000 worth of revenues. Glad to report fiscal 21 delivered in excess of 700,000. These all generated from group leads, so the cost of sales is extremely low. It's done through introduction, and of course we're hoping that moving forward we'll be able to see some repeat business from those transactions reoccurring in years to come. Obviously, as we closed out the year, we ended up in a very strong financial position. Adjusted net cash of 6 million as at the 31st of March. Very pleased to be able to report that, considering some of the challenges of the COVID year. Which puts us into the position of our organic growth now. We've got a very clear strategy, we've got a great team, and well supported from the group and from the board. And we have now got our position inside the industry. We're recognised, and so we do have a great opportunity for organic growth moving forward, and which now allows us to focus more on on acquisition during this coming year. Moving on, just to give you a little bit of flavouring on some of our KPIs. I mentioned about our cross-fertilisation, but collectively we've also had some very proactive sales where we've been able to attract 155 new customer wins, slightly up on previous years, but nevertheless these are opportunities where not only do we get the transaction the first year, but the way we actually build our service models and our delivery mechanisms allows us the opportunity to potentially get repeat business from these clients moving forward. One thing to note there is our software division. We generated 1.3 million of new uplift sales, which included the first set of sales from our new product offerings, which is very pleasing. Obviously, you'll notice there's a slight delta from fiscal 20, where we actually concluded 2.1 million sales. This is down to a bespoke large contract that we produced during fiscal 20 that wasn't repeated last year. It's for a foreign government, and it's a one-off. We do own the asset, which means that we do have the opportunity, should we choose to further explore opportunities in that vein. I mentioned about the recurring revenues. The revenue generated from cross-selling. And moving on to the recurring revenues, in fiscal 20, it's circa 40% recurring revenues. That's blended across the group. Just FYI, for our software division, it's circa 80%. This year, we're glad to report that we're slightly up on that. So it's going strong, it's going well, which obviously is very important for us to catch those recurring revenues. New business that we sell and we win, we obviously want to retain and grow in years thereafter. Which is very important when you come on to the last point there, on 60% of our clients have a 3-year or greater relationship with us. Now, what that means is that we must be positioning ourselves extremely well. We have a professional team that are delivering client services that are on point and required, and that customer services is second to none. We expect that when you look at our organisation, that we have a high opportunity to repeat on audits, on testing, and on some of our software renewals as well as we go forward. So obviously we would love to see that number grow as we report throughout the year. With that, I am going to hand over to Paul, who's going to take you through some of the detail around our financial results. Paul, if I can pass over to you, please. Paul?
If I can take you through this first slide, which provides looks at the key metrics that we use to manage the business. On the whole, despite the challenges that many businesses have faced over the previous year, the group has delivered a solid set of numbers with underlying Ebitda significantly ahead of the prior year. Revenue in the year of 31.8 million is slightly behind the prior year. And it's worth really noting the dynamics around the revenue movement in the period. It very much was a year of two halves, whereby in the first half, the business was impacted by the initial lockdown measures, which impacted our advisory businesses and did actually cause some delays in decision makings from our client base, which translated into a half-year revenue delta of circa 30%. I am very pleased to report that in the second half of the year, the group saw recovery in revenues, with H2 revenues 24% ahead of the prior year, as we saw returning confidence from our businesses, and obviously those delayed decisions starting to come through and allowing us to deliver on engagements. It's worth noting that throughout the whole of the year, our businesses have always been able to provide the services, even advisory businesses. However, on the part of some of our clients, there has been that they've taken decisions that during the initial COVID lockdown measures, that the client chose to defer some of these engagements. So I think it's worth mentioning that the business were always in a position to deliver on all these services. As we move through the second half of the year, we did improve our revenue position, and with Q3 reporting the pickup from some of those delayed orders, and Q4 then delivering some solid year-on-year revenue growth. Other things that have impacted the revenue, as Phil mentioned, the change in within revenue mix within our services business, whereby we have seen a greater proportion of managed service software type sales, which are characterized by a lower revenue point but a much higher margin, replacing some of those appliance-based hardware sales, which are characterized by high revenue but single-digit margins in many cases. Other impacts, so the full year would have incorporated a one-off software sale in the previous year, which hasn't been replicated in the year to March 21. It is worth noting that we did create an asset. We still have this asset, and we definitely believe there is an opportunity to resell this asset in the future. However, the challenges of COVID did mean that wasn't possible in the year just ended. Moving on to the second graph, our underlying Ebitda, very pleased to report an improvement of 9% year on year, delivering 3.7 million of underlying Ebitda, which was ahead of the market's expectations. With that, we posted improved underlying Ebitda profit margins of 12%, up 2% from the previous year. What's very encouraging and very pleasing to see is that both of our divisions, both our services division and our software divisions, delivered improved profit margin, underlying Ebitda profit margins in the year to March 21, with our software margins of 50%, up slightly by 1% from the prior year, and our services margins 11% compared to 8% in the previous period. As we move on to underlying profit before tax, which takes obviously the year-on-year improvements within underlying Ebitda, but also incorporates items such as finance charges and the amortization from some of our computer software developments. And I will come on to a little bit more detail around the movements in those figures in a later slide. What's worth noting is in the year to March 21, the group delivered its first reported profits before tax, and as a result, delivered its first reported positive EPS, delivering an adjusted EPS of 10p, which is 27% ahead of the prior period. If I can just move on to the next slide, please. This the table that you're looking at is a summarised version of our income statement for the year. So in terms of the revenue position, obviously I've already mentioned the impacts of COVID in H1, reducing those H1 revenues. However, we have seen a strong recovery in H2. Throughout this period, we have benefited from some solid reoccurring revenues, which are in excess of 40% now. A few other points that's worth noting, and I think this is something that, as we look forward to the coming year and future years, it's things that obviously do provide some optimism for us. Within the period, we saw our first sales of our new softwares being delivered, which, as we look to grow those sales out in future years, will help drive revenues, but also help push our margins forward. The recovery in advisory, so it's worth noting that whilst we did see a reduction in our advisory revenues of 27% in the year, our services division still delivered its revenue in line with the prior year, which really sort of shows the benefits of the group position. And within this, we saw some improved gross margins as well as Ebitda margins. The change in the revenue mix within our services division has, again, it has possibly caused us some more challenges around the loss of some of that hardware revenue, which was obviously always of a slightly lower quality of profitability, which obviously has impacted the top line. And very finally, obviously, the software revenues one-off costs, one-off revenues in the prior year, which wasn't repeated in the year state. Moving down to the gross profits line, gross profit margins of 33% is ever so slightly ahead of the prior year, but it's worth noting that both of our divisions, our services and software divisions, did report improved gross margins in the year. So firstly, our software division saw their gross margins increase from 75% up to 80% for the period, and that's down predominantly to two factors. Firstly, in the previous year, we conducted and completed a small reorganisation of our sales and marketing function, which did lead to some efficiencies being realised, which we reported at the half year, and I'm pleased to say that has continued across the full year. And secondly, in the second half of the year, as we started to see some sales coming through cross-selling opportunities from our services clients selling into our software divisions, the sale of some of those new product sets, again, supported that improvement in gross profit margin on a year-on-year basis. On the services side of our businesses, our gross margins grew modestly from 22% to 23%, and that obviously incorporates the changing mix within our revenue base within our services division. And I think it's worth mentioning that we've been able to achieve improved gross margins despite the fact that our advisory businesses had lower utilisation rates than we would in normal times have expected. So as we move out of H2 and into the current year, and we obviously see improvements within utilisations and the demand for our advisory businesses, that provides us an opportunity that we can build on those gross margins moving forward. Moving down to the next line, the overhead line. So we have made a 600k saving within our overhead base during the year, and this can be attributed to two main factors. Approximately half of this saving is the full year flow through of the reorganisation that took place in the first half of the previous fiscal year, whereby Phil and myself looked at the business as a whole and did make and some changes were made. The other half of the savings, circa 200 to 300k, has been achieved as a result of some delays to replacing of headcount, which through natural attrition, as people have left, as we've seen COVID approaching and the subsequent impacts on our advisory revenues, we have taken decisions to maybe defer the replacement of some of those vacancies, and again some of the discretionary expenditure on things such as marketing, just for that period. It's worth noting, however, that during the period, the year to March 21, and even in the first half, where we identified the need to recruit for positions, we did still recruit for some positions. Now, underlying the Ebitda of 3.7 million, which obviously demonstrates 12% underlying Ebitda margins for the year, which incorporates both the small improvement in the blended gross margin, and the overhead savings that have been made in the year. Below the underlying EBITDA line, we have made savings within our finance charge. This is due to the fact we've repaid a significant chunk of legacy debts at the first half in the first half of the year, which has significantly reduced that finance charge. Additionally, during the year, we swapped out an old debt factoring facility previously used with the group's new RCF facility, which is a more efficient way of financing. This saving has been offset by an increase in our amortization charge of computer software as a result of the go live of some of our new software products now going live and being sold. We are now starting to write that development off over a period of 3 years. This has contributed to an underlying profit before tax of 2.4 million, 9% ahead of the prior year, and demonstrates some good year-on-year improvements. Below this line, I'm not going to do a line-by-line walkthrough, but it's worth noting that we have that it's a lot cleaner than previous years, and we have seen a tidy up of deferred consideration in terms of we now have no outstanding deferred share consideration owing at the end of March 21. If I could ask you to move on to the next slide, please. Okay, this next slide provides some detail of our cash flow for the period. As per last year, I'm very pleased that we've been able to achieve strong cash flow in the period to March 21. We have maintained cash conversion in excess of 100% during the period, and we have noted that despite the challenges on some of our customers through COVID, bad debt levels have remained very small. Cash collection has remained efficient. We have put in additional practices to ensure that we maintain good cash collection across the group, and obviously due to the clients that we currently work with, whereby without our software side, where we have a lot of resellers, we're not chasing lots of individual end users, which does help when it comes to cash collection. And on our services side of the businesses, we're dealing with blue chip clients, which predominantly there are mainly within financial services and telcos, which possibly haven't been impacted to the same degree as, say, your retail or leisure businesses over the past 12 months. I would like to just draw your attention to the yellow box in the middle of this chart, this table. Just highlights, I have added in an adjusted cash generated from operations, which is at 5.3 million. So there's a 1.3 million delta. And I thought it was important that we incorporate this in. And the adjusting item is a VAT deferral, which we took advantage of in the previous year. That 1.3 million of deferred VAT will be repaid in the current year, but it's worth noting that will obviously create some softness in the operating cash flows in the current year. Other items on this chart to notice is obviously we are very much committed to investing in R&D within our software divisions. It's a big part of our strategy. And we have spent circa 700k on capitalised development in the year. Other items of note include a 3.8 million of proceeds from the issue of share capital, and that was from the fundraise which took place in April 20. And the purpose of that was to provide us funds for our next acquisition. As I'm pleased to say, we retain those funds, and we are still planning on using that obviously for our next acquisition. Other items, 4.2 million represents loan repayments during the year, and it's worth noting that at the 31st of March 2021, our loan balances had dropped from 4.9 million the previous year down to about 700k at the end of the period. So significant reduction in debts year on year. Just moving on very quickly, other items worth noting is that in addition to strong financial position that we found ourselves in, that's the end of March 21, we have added a group RCF facility during the period, which provides us additional contingency and to support our next stage of our growth. I think to conclude on our financial performance for the period, I think it's worth highlighting this, the group has delivered profits ahead of expectations. We've delivered underlying Ebitda 9% ahead of the prior year. We've delivered improved adjusted EPS of 10p compared to 8p in the prior period. We now find ourselves with a solid financial platform. We're well capitalised, and with the addition of an RCF, which is currently unutilised, we're in a good position as we look to now move on to the next stage of our development. And I think very finally, whilst delivering these results for this period, we have obviously identified some opportunities for further growth in the year ahead. Thank you. Phil, back to you.
Thank you, Paul. And first of all, I must say Paul's actually working very remotely today, and he's only able to join us via conference call. So apologies that you can't actually see Paul on screen. Let me just take you through a few more slides now. First of all, a little bit about our vision and our strategy. Obviously, what we're looking to become is a provider of choice. We still got two sides to our strategy, in that we're obviously looking to build a profitable company organically, cross-fertilising and sharing where we can, and actually growing our position inside the market space into a profitable organisation. We'll continue to develop, as Paul said, with our R&D into our software division and building out that platform. And I'll come on to that in a few moments. But obviously, one of the key areas for us is the focused acquisition. We're looking to obviously to continue with our key strategy of buying organisations that have that are either feature-rich in software, which we can actually add to our software platform, or they are services-based companies which will add to our client base. Obviously, we're looking for cash generative, accretive organisations that we can blend in. Moving on, just to a little bit on our services side of the business in terms of some of the new wins. The little chart there on the right-hand side, you can see what that is just giving you a little bit of a breakdown of the numbers of where our business is currently located. As you can see, we're very high percentage of our business is within the telco space, followed by that of the banking. And these are a couple of two key components which actually dragged us through, obviously, COVID to actually produce the numbers that we have today. Key activities, key strategic contracts with organisations in this space, critical infrastructure. Everyone still wants to use their mobile phone. Everyone still wants to use their broadband. So you can understand why that we're very keen on actually continuing to develop this area. I'm glad to report we deliver to the telco and the banking sector, not just domestically, but internationally as well. Within the business, in the banking business, we tend to deliver an awful lot of cyber threat, security-based solutions, whereas in the telcos, there's a lot of packet monitoring and cyber defence. Just to give you a little bit of a breakdown, obviously, when we can, we do announce it via RNS, but if you don't hear from us on an RNS, it means that we're still winning clients. As we mentioned earlier on, 155 new clients came to the table. So we're still winning, and if obviously there's anything notable, we will let you know. Also, during the pandemic, we had to think on our feet pretty quickly, and I'm glad to say that whilst parts of the organisation were suffering, we managed to do a workaround with other parts. Our advisory business had a soft start to the year, and obviously they started moving from a face-to-face to, in the second half of the year, where they're able to work via video conferencing. Likewise, with our penetration testing division, where they weren't able to actually go out and visit the clients, what they did, they deployed drone laptops. So they sent the client a laptop, connected through that into the client's network, and able to continue with their work. That obviously contributed to picking up some of the slack inside our utilisation rates. Also, one of the things that we've already previously mentioned is obviously our cross-selling. It's integral to who we are and what we're doing, and I'm very pleased to report that not only are we sharing businesses and opportunities, we're now actually bidding collectively for new deals. So obviously it reduces the cost of sale, which means we can maximise our efforts, and hopefully we can take more of the client revenue off the table. Just to give you some idea of some of the leads that we've been transferring around. For example, we've pen tests were supplied 15 leads into the Shearwater Group companies, and they received 28 of those leads, which were a combination of staff incentive program generated leads and obviously existing established customers. On the back of that, they won 10 of those. And obviously, in the type of business that they're in, same with our advisory, there's an opportunity for repeat business to come along in the following years. As with the specialist solutions of Brookall, where they engage with on key infrastructure, obviously there's a tendency where we have an opportunity to get repeat business. Moving on. Just take you through a little bit of our software. You may remember this slide from last year. It's slightly changed a little bit. And one of the things that we have here is obviously our competitive landscape. And you can see along the top here, some very big players. You know those names, they're out there. They go very deep. CyberArk is a very big, heavy lift. It's a very good product, very well established. It sits in Gartner's top right-hand corner. And they do target for the Fortune 100. They fight it out amongst those other giants there. But inside our Secure Envoy platform, what we're looking to do is actually continuously build upon what we have. Today, on the acquisition of Secure Envoy, we acquired the multi-factor authentication. At the time, that was just a disk-based product. It turned up as a single license, and you installed it in your data center. Now I'm glad to say they have developed into a cloud also platform. So now we have toe in both camps, which is obviously meets the requirements of a lot of organizations today. We have identity access management has been developed there. So 2 leading products. This organization, don't forget, won the Queen's Awards for innovation and for export. So we're very proud of the quality of the work that these guys can produce. On top of that, we acquired GeoLang. And GeoLang, they focus around the DLP. And we've now got the ability to actually ingest some of their code onto our platform, allows us to actually represent that to our 350 plus resellers around the world. Also, we sell that technology from directly through to our corporate client base, and I'm glad to report that some of those £700,000 worth of sales actually contributed from GeoLang. You can also see in there the PAM, the CAS, and the IGA. Those areas there are the areas where we have the opportunity to either acquire a company or we will develop that software ourselves in-house. Obviously, to acquire will be quicker than the development, which can take a period of time. And the reason we're doing this is all referring now to these components, the MFA, all the way through to the IGA. Gartner is now citing this as being the converged platform, and it's the SaaS-delivered target that we're going after, and this is where we want to position ourselves. We want to be that company of choice in providing the authentication as a service in that new market space. And Gartner have ratified our strategy and saying that this will be a key component by the year 2023. Moving on, I'll take you now just through a couple of slides. First of all, in terms of our current trading. Well, first of all, what's driving all of this? The current trading outlook, the market drivers haven't changed. Cyber threats are up, regulations increasing, and according to the government, there's shortages on staff, and obviously we address those key components. So what we did see is a softness and a changing of our revenues in H1 of last year. We saw some of that recovery of the revenue in Q3. But more importantly, in Q4, we saw strong optimism coming back, not only to our teams, but also to our client base. And we saw utilization rates increase, and we saw the activity, the number of bids coming through. And we even saw some deliverables being pulled forward because the customers had more confidence about the effects of the vaccination on the UK. As a result of that, that obviously allowed for that optimism to flood over into Q1, and I'm very pleased to be able to report that current trading in Q1 once again was very strong and on plan. And I'd like to think that obviously with COVID disappearing into the rearview mirror, that confidence will grow on a continued basis. Furthermore, we're seeing obviously a need to grow our business out and to actually increase our headcount. And this is obviously to support future growth in fiscal 22 and to build upon our current pipeline of opportunities that we have in front of us at the moment. So in terms of the outlook, Paul mentioned earlier on the underlying profit before tax is up 9%, adjusted EPS is up 27%, underlying Ebitda is up 9%. So we're building upon some very solid foundations now. The company is in a very good financial position. It's well capitalised. We've cleaned up an awful lot of the issues and challenges that we had previously, and we're now very confident about moving forward. We're now got planned investment for headcount across sales and from technical. So we're looking to actually add more people into our development and support, as well as sales people across the group to actually go out and increase that activity. We're not only developing our sales in the UK, but we're also looking to actually push some of that out into the US. Obviously, we got now the opportunity where we've been developing our software over the last couple of years, and it's now on in cloud as well as on-prem. We've also been adding new features to it, new applications, new methods and technologies. We've also had obviously the first set of revenues coming through from these softwares. And obviously we can look forward, hopefully, to seeing an increase realisation of some of that investment in the years to come. Also, we've been very much focused on growing out our reseller base from our software side and making sure that we can actually meet the needs of the reseller and grow that footprint. The more of those resellers we have, obviously, the more points of presence that we can generate and potentially win new client business in country in that territory. As we move through, obviously we expect to see some of our margins may change, may shift with the adjustment of COVID and now working environments. You've got to appreciate, 15, 16 months ago, we went from working in an office environment to working at home. We saw 4 years of digitalisation in 4 weeks. As a result of that, that may change and shift some of their margins in the future years, but we're well adjusted to actually accept and work with that. Most importantly, obviously, we had to get our company in order, get our foundations working well, get a good cash position. That now allows us to, the organic strategy is working well. We've proven that. We're now breaking net profit. We're very pleased with that position. It's well supported from the top all the way down. Our policies and procedures are well maintained inside the group. We're a very clean company, and now it does give us time to actually now focus on M&A, which I know is something that we're all looking forward to. And with that, it comes down to just some closing remarks. As I mentioned, the cyber threats are increasing. Regulations increasing. We're a company that deliver into that space. We have our own product set where we own our IP, and we have high recurring rates of repeat business there, circa 80% as a number. And blended across the business, our services side contribute a large amount of client base, large amount of corporate clients, a lot of repeat business, circa 45%-ish or 40-45%-ish as a blended number. We're in a place where the market is growing, and we're as we come through this COVID period, I'm pleased to report that all of our senior leadership teams are very enthusiastic about this coming year, and they're meeting it with heightened enthusiasm and confidence. And I'm pleased to report that the management team and the board of directors therefore think the future is very bright for our organisation, as do I. And with that, I believe I've come to the end of our presentation. And with that, I would like to pass back over to the invigilator.
Phil, Paul, thank you again for your presentation. Ladies and gentlemen, do please continue to submit your questions using the Q&A tab situated on the right-hand corner of your screen. Just click Q&A, type your question and press send. But just while the company take a few moments to review those investor questions submitted already, I'd like to remind you that recording this presentation, along with a copy of the slides and the published Q&A, can be accessed via Investor Dashboard on the Investor Meet Company platform. I'd also like to remind you that your feedback is important to the company, and immediately after the presentation has ended, you'll be redirected for the opportunity to provide feedback in order that the company can better understand your views and expectations. Phil, Paul, we have received a number of pre-submitted questions from investors, and perhaps we could start the Q&A session with these. If I may, I'll read out the first one. The first one reads as follows. I believe there was mention of a 2 million contract signed last year around Christmas time to be fulfilled this year. Is that still happening? And perhaps, Phil, I can address that to you, please.
Yeah, certainly, yeah. And we actually had, it was actually in September. We had, the client had some challenges. It's a big deal. It needed a lot of sign-off. The client was also a bit concerned by COVID and working from home. So they placed the order with us. They needed a portion of that was delivered at the tail end of September, I believe. Probably circa about 300K. What we then saw, obviously, with the increased confidence in Q4, the client decided to bring some of that forward. They brought around about 3 million of that forward, and it left circa 600,000, which we expect to actually deliver during H1 this year. So hopefully that answers your question.
Fantastic. Thank you, Phil. The second one, I think, again, I'd like to address to you, actually. There's been a progressive drop in the share price over the past 3 months to date. Would the board like to comment, please?
Unfortunately, I can't. I'm not allowed to comment on the share price of the organisation. The only thing I can say is the company has delivered its best results ever, and I'm surprised, and that's all I can really say on it.
Thanks very much. Thank you, Phil. The next one we've got here, I think it's perhaps one for Paul, actually. You highlighted a 39% increase in revenue in October, November compared to the previous year. In the December update, after a drop of 30% in revenue in the preceding months, how well did the following months in 2021 perform compared to the previous year?
Obviously, we've noted we have seen a blended year-on-year improvement in H2 of 24%, and as per the previous RNS, October and November revenues grew by 39%, which incorporated some benefits from some of that catch up from H1. I don't have a month-by-month breakdown to share, but I can say that Q3's revenues were circa 30% ahead of the prior year, and obviously that's incorporated probably a larger proportion of that catch up from H1. Q4 revenues, which obviously is a bigger quarter for the business, they grew by circa 20%.
Fantastic. Thanks so much indeed, Paul. Phil, perhaps another one for you. You mentioned 0.7 million revenue achieved from cross-selling. Is this the first significant amount, open and close brackets? Clear that the Brookcore acquisition is the backbone of the company. Will you be expecting cross-selling to grow more quickly? And is this the main reason behind acquisition, both past and future?
First of all, yeah, Brookcore is a significant contributor to the group. It's a specialist company, sells solutions, and the types of clients they engage with, they do generally have long sales cycles. So obviously, wherever we can, we make sure that we can introduce other parts of our organisation. When we do get the opportunity to cross-sell, and we do, when we do win those opportunities, what you're seeing is obviously, hopefully, an opportunity to repeat business. So that very, very first sale we did, as small as it was, in the first year, was the most important one, because that means that we've got the capability in-house to actually do it. So will it grow? It certainly it's one of our KPIs. So we're going to be measured against it. We're looking at that, and we're driving against it. We have an incentive program which we're about to relaunch and to the company, And we're hoping, obviously, as we get better understanding of each other in the portfolio companies, we'll be able to represent that, and our sales teams will be able to act more effectively with obviously better knowledge and experience of dealing with some of those other new service offerings. So I do expect it to grow. I would like to think it will grow. I would like to think that we will get repeat business out of that as well on an ongoing basis. And obviously, if we acquire another company inside the service space, we'd like to think that they'll be able to add additional client to that list as well. So once again, feeding that opportunity for cross-fertilization.
Fantastic. Thanks again, Phil. One for you actually, Paul, here. We've got, why are you no longer breaking out the revenue for the separate trading companies, please?
Well, I think it's worth noting we have always presented our revenues by segments, our software segments and our services segments. I think over the last 2 years as well, and I think it's more appropriate that we've really tried to sort of adopt a culture of collaboration amongst our individual entities, and especially if you look at our services division, whereby each of the businesses work very closely with each other. So I think it's possibly more appropriately that we report this way. We always have reported based on those divisions, and as companies are working closer than they ever have before, it's a sensible way of reporting.
Thanks very much, Paul. The final one we've got here pre-submitted, perhaps one for both of you, but perhaps I can start with Phil. What is the ambition for the business? At the moment, we've got a small group of operating businesses, none of which are growing very fast, if at all, in a sector that's growing fairly rapidly.
Well, yeah, I'll let Paul talk about the growth side of it, because the company has been growing, as demonstrated in the numbers. In terms of what is the purpose of it, we've got two sides to our organisation. We've got a software side and a services side. We're in that cyberspace, and advisory supporting services around that. And what we want to do is we want to build our platform out. We believe that is a unpolished gem which will compete on the global stage. It has a very good position, it has a very good reputation in the market space. It owns a number of patents, and we're very proud of what they're able to achieve. The team work extremely hard, and they demonstrate that year after year, and they have a good grasp on where the market space is going. It's very much in tune with where Gartner's suggesting it's going, and the strategy is defined on that. So that software division will become we will add additional features to that as we either acquire companies or we develop that software ourselves internally. Our software side, we're award-winning. We've won a number of recognised industry awards for what we do. I believe it's in excess of 27 of them to date, so pretty significant. We are looking to develop our skill sets further and become a key component for our clients, which is a must-have. You have to audit. You have to protect yourself from a GDPR perspective. These are key components. So obviously we're looking to grow that, and we will be an organisation with two heads. We will develop a software strategy and a services strategy. I would like to think that would de-risk any investor, knowing that we have those two different types of offering inside our organisation. In terms of the numbers, Paul, hopefully, can you give us just a little bit of flavouring from the growth line on what we've experienced?
Yes, so in terms of our growth over the year to March 21, obviously we've mentioned we've seen improvement in underlying Ebitda of 9%, underlying profit before tax improvements of 9%. Also, I think in addition to this, the adjusted EPS growth of 27% does demonstrate some improvement on a year-on-year basis. And I think it's worth noting that actually, as we look forward, obviously we can look at things that today we're starting to see those first sales from our new software products, which there is an opportunity for incremental growth, both to our existing clients, as we were able to offer for our reseller channels, additional functionality, which will give us an opportunity for incremental revenues in our existing client base, but as well as obviously we're looking to invest in sales and marketing across all of our businesses. That will drive further revenues and further new business as we move forward. So I think there's the opportunity to grow the revenues from those new product sets, which which we haven't seen the full impact of yet. I think as we obviously I can't say as we move away from COVID, but as our advisory businesses see improvements, and we have obviously seen some very positive signs, those utilisation rates, which despite the year obviously them being suppressed in the year to March 21, the services division still delivered improved gross profit margins. As we start increasing those utilisation rates, and we are seeing that will further provide additional revenues, but improved growth margins as we move forward. The cross-selling that Phil's noticed too is a KPI that we do monitor, and an important part of this is when we make that first sale, putting ourselves in a position where we can see repeat sales as we move forward, and as every year we get the benefits of those repeat sale, a proportion of repeat sales from those cross-selling opportunities. It does give us the ability to grow incremental revenues from that. But the more important thing here is that the introduction of more of those sales does further enhance our gross profitability. So it gives us opportunities where double-digit revenue growth in the future there are opportunities for us to deliver that, and obviously with that improve, and also there's opportunities for improvement in the margins that the business is making, and I think in the year to March 21, those improvements in margins has started, and as we move forward, it's something we would like to. We feel there's opportunities where we can progress that in the future.
Fantastic. Thank you very much indeed, Paul. Paul, we have had a number of questions submitted during the presentation today. Perhaps if I may just pick a few of these out as we come into the close of the meeting and just read them out where appropriate to do so, and you can just give your response. The first one we've got here is, how does your offering differ from Darktrace, whose sophisticated software helps to detect breaches and who also supply to the UK's major companies?
Yeah, the Darktrace, good company, good product. We know it. Our software, first of all, is at Secure Envoy and GeoLane, focused obviously around authentication and DLP. What we have, we're in a different sector to that. What they're looking for is obviously looking for the anomaly behaviour. They're looking for the threat coming into the network, and so it's very, very different from our software. However, on our services side of the business, through Brookcourt, we actually do sell solutions that will be in existence in the same customers as someone like a Darktrace. And there we provide a lot of threat feeds, we build a lot of cyber solutions for leading firms, banks, and telcos. And one thing you will find is with a lot of those types of customers, they won't buy one solution; they buy 2 or 3 of them. They like to be holistic, like to overlay different technologies to make sure that they're protecting their assets accordingly. And Darktrace itself, I will say we haven't lost a deal to Darktrace, but there again, I haven't necessarily come across Darktrace on a head-to-head bidding environment. So, but I have seen Darktrace are in existence in some of our customer base as we are in theirs. So it appears to me that the customers investing in both sides of that type of technology. Inside our solutions, we don't just do one thing, we do multiple things. So we will have different ways of looking at the problem, and whereas obviously Darktrace, they have their chosen methods, and I will say they work it very well. It's a very good product.
Fantastic. Thanks very much indeed. Next one we've got here. Do any of your historic acquisitions require any further cash payouts?
Maybe I can answer that one. So obviously during the year to March 21, we did repay a significant amount of legacy loans, which were related to historical acquisitions. At the end of March 21, all deferred share considerations had been repaid. So there's no further share considerations owing. And in terms of remaining cash payments, there was circa 700k, which was in relation to the Pentest acquisition that took place in April 19. Please say we have repaid some of that in the first quarter of the year, with the balance repayable in April 22.
Thank you very much, Paul. And I think probably we've got time for one more. I would like just to remind the attendees, of course, the company review all questions submitted today. So thank you very much for submitting those. The final one we've got here is, would you be looking at organisations that are not UK-based to integrate within the Shearwater Group, or are you looking at UK-based cash-generative businesses only?
We're looking at cash-generative businesses. We are historically we're a UK-based company. Majority of our activities are here, but we are looking to obviously at the opportunity itself. So we're not restricted to the UK. We're restricted to make sure that we're buying the right company for our organisation, that we're getting the right value. So it's accretive value. So it's earnings enhancing. And if that's in this country or further afield, then that's fine by us.
That's great. Thank you very much indeed, Phil. And if I may, Phil, just perhaps a few final words just before we redirect the investors to give you some feedback.
Yes, thank you. First of all, I'd like to thank you once again for taking the time out of your day to actually visit us. We will try and make give you updates on from our RNSs as and when they're appropriate. And obviously, if you need to reach out to us and talk to us, please do so. The email address, the best one to contact us on, is shearwater@alma.co.uk. They'll be able to handle that for you and make sure that we can actually respond to you if, of course, we can. And with that, I would just like to say thank you very much once again. Thank you very much for your support in helping us grow this organisation, and hopefully that we will be able to report positive things for you in the H1 moving forward, and thereafter. And back to you. Thank you very much.
That's great. Thank you very much, Phil, Paul, for updating again investors today. Could I please ask investors not to close the session, as you'll be automatically redirected for the opportunity to provide your feedback in order that the management team can better understand your views and expectations. This will only take a few moments to complete and is greatly valued by the company. On behalf of the management team of Shearwater Group PLC, we'd like to thank you for attending today's presentation. That now concludes today's session. Thank you. Good afternoon.